Debt is like a two-sided blade. It can quickly make you very rich or just as fast make you poor. In our video, we're going to show you how rich people use debt to build more wealth. We'll also see how debt can be a strong force that helps you achieve your dreams and goals. Watch this video as we reveal how to use debt smartly, turning it into a tool for success rather than a path to financial trouble. 1. The rich build empires. The story of how rich people use debt to get ahead isn't new. It started way back in the 1800s with Rockefeller, who did business that would be worth $400 billion today. Rockefeller wasn't born rich. He was the son of a farmer and left school early. Yet he became the richest person in America, even richer than Jeff Bezos, Bill Gates, and Elon Musk combined. He didn't do well in school because they didn't teach about money. But once he got a job as an assistant bookkeeper, he learned all about business. With just a $1,000 loan from his dad, his first step into debt, Rockefeller jumped into the business world. In 2 years, he turned that loan into a $17,000 profit. Seeing a chance in the growing oil industry, he used new methods to make things cheaper and beat the competition. His smart moves and the trust he built with bankers got him better loans, which he used to buy out his competitors and control the oil market. By making deals to get cheaper rates for transporting his oil, he made kerosene affordable for more people. In his 30s, he became a millionaire, and his company, Standard Oil, controlled 90% of the oil in the US. The key to Rockefeller's success was smartly using debt to grow his business, always paying back his loans on time and borrowing again when there was a good chance to grow even more. 2. The rich don't take salary. While many of us are familiar with the extravagant lifestyles of the rich, billion-dollar homes, flashy cars, and lavish vacations, it's less known that they often don't fund these luxuries with a salary. In 2021, Elon Musk shed light on this with a tweet stating he doesn't take a salary but instead has stocks, indicating the only way he pays taxes personally is by selling stock. This hint suggests a deeper strategy. Musk, and many like him, don't rely on a conventional paycheck but own valuable company stocks which they don't sell. Musk's lifestyle is financed through debt, using his stocks as collateral to borrow money. This method serves dual purposes. Firstly, it avoids immediate tax payments since borrowed money isn't taxed, allowing him to enjoy his wealth without the tax burden. Secondly, it sidesteps the capital gains tax that would apply if he sold his stocks. Instead of selling, he uses them to secure loans, effectively an ongoing line of credit. For instance, if Musk borrows at a 6% interest rate, he just needs Tesla's value to grow by at least that much. When it's time to repay, he simply takes out a new loan against his stocks, paying off the previous debt. This cycle enables Musk to maintain his opulent lifestyle without dipping into his stock wealth, showcasing a savvy financial strategy beyond the reach of the average salary earner. 3. The rich love real estate. The wealthy really like investing in real estate, unlike most people who struggle just to pay off one home loan. They borrow money to buy many houses all over the world, and what's more surprising is they often don't even live in these houses. For instance, rich people like Elon Musk borrowed $61 million to buy 5 houses in California in 2018, even though he could have easily paid cash. But why do they do this when they have enough money? The big difference here is that regular folks usually borrow money for things they can't afford to buy outright, but wealthy individuals borrow even when they have the cash to pay up front. The main reason? Borrowing money like this means they don't have to pay taxes on it. Let's break down how they make money from real estate. Say you find a house worth $1 million. You get 80% of that amount as a loan from the bank, and some investors cover the other 20%. If the cost of your loan and keeping the house in good shape is $120,000 a year, but you can rent it out for $140,000, you end up making $20,000 without using any of your own money. And you don't have to pay taxes on this money because of something called depreciation. Depreciation is like an imaginary cost that says your property is getting a bit older and worn out, which you can deduct from what you make. So, even though you're making money, on paper, it looks like you're not, and that's why you don't owe taxes on it. This smart move helps the rich get richer by making their money work for them, all while avoiding taxes. 4. The rich don't mix things up. When Elon Musk decided to buy Twitter, he chose to borrow $13 billion, even though he was almost worth $250 billion. This move might seem strange to many, because with so much money, spending $13 billion directly seems possible. However, Musk had a strategic reason for taking out a loan for this purchase, known as a leveraged buyout. LBO. In an LBO, the money borrowed is backed by the company being bought, here being Twitter. Lenders give the money thinking that Twitter will earn enough to pay back the debt. Musk didn't just buy Twitter for profit. He saw it as a way to push for social change and protect free speech. But since he wasn't sure how much money Twitter would make, using an LBO was smarter. If Twitter does well, Musk benefits more. If it fails, he only loses what he put into Twitter. The lenders can't make him pay the debt with his personal money. They can only try to get their money back by selling Twitter's things. It's not clear yet if selling Twitter's things would fully cover the debt if needed. But by borrowing the money, Musk made sure his own wealth was safe. His other businesses are kept separate, so even if Twitter has problems, lenders can't go after his Tesla shares worth $94 billion, allowing him to maintain his lifestyle. 5. The rich inflate out their debt. In 2012, Mark Zuckerberg secured a mortgage with a super low interest rate of 1.05%, far below the average, thanks to his $15.6 billion net worth, which assured lenders of his ability to repay. This move was strategic beyond saving on interest. Zuckerberg invested his funds in higher return opportunities instead of locking them into a home purchase, maximizing his profits. Additionally, by choosing to pay off the mortgage over 30 years, he capitalized on inflation, making future payments significantly cheaper in real terms. This clever maneuvering not only got him his dream home, but also allowed him to grow his wealth more efficiently. 6. The rich generate liquidity. The wealthy love to buy assets and keep them forever, often planning to pass these valuable assets to their children. They understand that the value of these assets will likely increase, so they prioritize securing their family's future over being completely debt-free. This approach doesn't stop them from jumping on big investment chances. While their own money is tied up in assets that are not easy to turn into cash, they use loans to seize profitable business opportunities. In April 2023, Mukesh Ambani, the head of Reliance Industries, took out the largest loan in Indian corporate history, borrowing $5.5 billion for a nationwide 5G rollout in India. This amount is just a small fraction of his total net worth of $82 billion. Ambani's massive home in Antilla is valued at $2 billion, and with his other global properties, he could have easily funded the 5G project without a loan. Yet, he chose to borrow, aiming to leave his vast assets to his children, Akash, Anand, and Aisha. The 5G project is expected to significantly boost India's economy by $180 billion by 2030, contributing to 2% of India's GDP. Ambani, a telecom giant, understands the potential gains well. He prefers to borrow now and pay off the loan with future 5G earnings rather than lose market share to competitors. Withdrawal investing insights, signing off, and this is not financial advice.